Good afternoon and welcome to the OBR's press conference for our March 2024 Economic and Fiscal Forecast. I'm Steve Farrington, Chief of Staff of the OBR, and I will be chairing this event. I'm joined by the three members of the Budget Responsibility Committee, the Chair, Richard Hughes, along with Professor David Miles and Tom Josephs. In a moment, Richard will run us through a summary of the forecast that we have just published, after which the committee will take questions, both from those of you here in the room and those joining online. If you are joining us online, then you can submit questions at any time via Slido, which you can find via a link on our website. And with that, over to Richard.
Thanks, Steve, and good afternoon, everyone. I'll first take you through our latest forecast for the economy, and then turn to what it and the policies announced by the Chancellor in today's spring budget imply for the public finances. Less than 3 months have passed since our last forecast, and the period in between has been relatively uneventful economically, at least by the tumultuous standards of the early 2020s. Nonetheless, there have been some developments in the interim which have had a material impact on our view of the UK's economic and fiscal outlook. First, inflation has come down more quickly than we expected in the autumn. CPI in the final quarter of 2023 was 4.2%, 0.6 percentage points lower than we forecast in November. And we now expect it to fall below the Bank of England's 2% target by the second half of this year, helped by falling global energy prices and a cooling domestic labour market. Our central forecast then shows inflation remaining just below 2% until the final year, when we assume the output gap is closed. Recent disruptions to global shipping through the Red Sea, associated with the ongoing conflict in the Middle East, pose a significant risk to this more favourable outlook for inflation. Its impact on our central forecast is relatively modest, adding just 0.2 percentage points to CPI at its peak in 2025. But we also consider a scenario in which the current conflict spills over to other parts of the region, interrupting oil and gas exports. In this scenario, quarterly inflation spikes back above 7%, and real GDP contracts by around 1% at the height of the disruption. With global and domestic inflationary pressures easing, market participants now expect a sharper fall in interest rates than they did in November. When we took a print of the market curves in the lead up to the 23rd of January, bank rate was expected to fall from its current 15-year high of 5.25% to just over 3% by 2026, around 0.75 of a percentage point lower than we forecast in November. And 10-year gilt yields stood at 3.9%, about half a percentage point below their November level. But interest rate expectations have remained highly volatile since they started rising in the second half of 2022. In just the 3 months since our November forecast, medium-term expectations for bank rate have been as high as 4.2% and as low as 2.7%. In fiscal terms, that's equivalent to an additional £5 billion more or £3 billion less borrowing in the fifth year of our forecast. But perhaps the biggest economic development since November has been what we've learned about the size and composition of the UK population. While the ONS continues to face challenges in gathering comprehensive and reliable data, two key releases over the past 2 months have shed further light on post-pandemic developments in the labour market. The first is the ONS's new net migration data and population projections published in January. The second is the ONS's reweighted labour force survey, which came out last month. As you can see from the chart on the left, the ONS's latest data show that annual net migration reached 670,000 in the middle of 2023, 70,000 more than we assumed in our November forecast. Informed by the latest ONS projections and changes in the visa regime announced late last year, we now expect net migration to fall back sharply over the next few years before settling at 315,000 per year in 5 years' time. Compared to our November forecast, this adds an extra 350,000 people to the overall size of the UK population by the fifth year of our forecast. But given considerable uncertainty about the level of future migration flows and the impact of recent policy changes, we also explore the economic and fiscal implications of cumulative net migration being 1 million people higher or lower over the next 5 years. The second thing we learned from the ONS over the past 3 months is that levels of economic inactivity amongst the resident population are also higher than we previously assumed and are expected to rise further. The latest ONS labour force data from February suggests that the demographic composition of the labour force was more heavily weighted toward groups with lower participation rates. And rather than continuing to decline from its post-pandemic peak, the number of inactive working-age adults has rebounded over the last 6 months to 9.3 million, 700,000 more than before the pandemic. And long-term illness is both the most common and fastest growing reason for being outside the labour force, accounting for 1 in 3 people in this group. These worrying trends suggest that the overall labour participation rate is likely to continue to fall over the next 5 years, rather than making a partial recovery, as we assumed in November. As you can see from the chart on the right, by the end of the forecast period, labour participation is now expected to be 1.5 percentage points lower than at its pre-pandemic peak, and 0.5 percentage point lower than we forecast in November. Turning to what all that means for our GDP forecast, as you can see from this chart on the left, latest outturn data suggests that the economy has largely stagnated since the pandemic, and output contracted slightly over the second half of last year, rather than growing by 0.1% as we expected. This means that the level of real GDP at the start of this year is slightly lower than we anticipated in November. But our forecast for economic growth thereafter is largely unchanged. This is because the positive effect on GDP of a larger population, lower energy prices, lower interest rates, and a small boost from the measures in the Chancellor's spring budget is almost fully offset by the negative effects of lower labour participation, average hours and productivity, both in outturn and over the forecast. So by the end, the overall level of GDP is just 0.1% higher than we forecast in November. But as you can see from the chart on the right, GDP per person continues to fall to a trough of 1.25% below its pre-pandemic peak in the middle of this year, and ends the forecast almost a full percentage point lower than we expected in November. And varying the level of net migration over this period by 200,000 per year has a meaningful effect on the level of aggregate GDP, but makes much less difference to GDP per person. Turning to what these economic developments imply for the public finances relative to our November forecast, lower bank rate and gilt yields reduce debt interest costs, shown in dark blue, by around £14 billion per year over the forecast. And lower inflation reduces welfare costs, shown in light blue, by a few £1 billion a year. But it also reduces nominal earnings, and therefore tax receipts, shown in yellow, by amounts rising to £15 billion by 2028-29. The net effect of these changes in our pre-measures forecast, shown in the white diamonds, is to deliver the Chancellor a modest fiscal windfall of around £10 billion a year over the next 2 years, but leave total borrowing largely unchanged by the final year. In his spring budget, the Chancellor announced a front-loaded package of tax cuts and spending increases, shown in green, which cost around £10 billion a year over the next 2 years, but whose cost is partly recouped by tax rises at the end of our forecast. After accounting for the cost of these measures and their effect on the economy, this leaves post-measures borrowing, shown by the black diamonds, around £4 billion higher in 2028-29 than we forecast in November. Looking in more detail at the spring budget policy package, the Chancellor spends a total of around £40 billion over the 5-year forecast period. The single largest element is a further 2p cut in national insurance contributions at a cost of around £10 billion a year. There's also the traditional 1-year freeze in fuel duty, costing a further £3 billion in 2024-25. But the budget also announces new taxes on vaping and carbon imports, and a new tax regime for non-DOMs, which together with other anti-avoidance measures raise a total of £7 billion of extra revenue by 2028-29. The only major spending item is £900 billion a year to be invested in pump priming efficiency savings in the NHS and other public services over the next spending review period. The further net tax cuts announced in this budget help to reduce the overall tax to GDP ratio by around 0.5 percentage point relative to our November forecast. But it's still set to rise over the next 5 years to close to a post-war high of just over 37% of GDP. About 1/3 of the 4 percentage point increase in the post-pandemic tax take is due to the decisions to keep the main personal tax thresholds and allowances frozen in the face of higher inflation since 2022. This drags growing numbers of people into higher tax bands, creating over 3 million more taxpayers, with over 2 million more higher rate and over 500,000 more additional rate taxpayers by 2028. The next cuts and other measures in this budget also provide a further boost to labour supply, on top of the other reforms announced in the last 2 fiscal events. As you can see from this table, we estimate that the 4p worth of NICS cuts announced over the past 3 months will boost the effective supply of labour by around 200,000 people over the next 5 years. Other reforms to pensions, benefits and childcare add a further 100,000 to the labour supply. But the increase in marginal tax rates for those dragged into higher tax bands is also likely to have a negative effect on work incentives, which we quantify for the first time in this EFO. We estimate that freezing rather than indexing the allowances and thresholds in the personal tax system since 2022 is likely to have reduced total hours worked by the equivalent of 130,000 full-time equivalents by 2028-29, with just over half of this effect having already been realised and a bit under half still to come. And as you can see from the bottom line of this table, the net effect of all these decisions on the labour supply is to boost it by just under 200,000, which is an important contribution to tackling one of the UK's biggest supply-side challenges. But it's also equivalent to just over a quarter of the rise in working age inactivity we've seen since the pandemic. Turning to public spending, apart from the temporary injection of capital into the NHS, the Chancellor has once again left the path of departmental expenditure limits, or DELs, largely unchanged in this budget. DELs account for just over 40% of public spending and are allocated out between departments in periodic spending reviews. The last spending review was conducted in October of 2021 and set multi-year budgets for each department in nominal terms up to 2024-25. And the Treasury's announced today that it won't be conducting another spending review until after the next election. As you can see from the chart on the left, this means that 4 out of the 5 years of our forecast for this large proportion of spending are not based on any detailed departmental plans from the government. Instead, the Treasury simply provides us with an assumed level of total current and capital spending on public services for the period beyond March of next year. As you can see from the chart on the right, the real per-person spending power of these plans and assumptions has been steadily eroded over the past 3 years. Starting with the blue line, this shows you what the government's public spending plans implied in terms of real spending per person when they were first set out in October of 2021, around £8,200 per person by 2026-27. As shown in the yellow line, these plans were topped up in cash terms in subsequent fiscal events. But the last 3 years has also seen much higher inflation than anticipated, for which budgets were not fully adjusted. This reduced the real spending power of those plans by around 6%, as shown in the green line. And finally, the last 3 years has also seen high levels of net migration and population growth. As shown in the purple line, this reduces real spending per person by a further 2% to just under £7,600 by 2026-27. So the net result is that real departmental spending per person is now expected to be around £600 lower in 2026-27 than was implied when the government first set out its plans in October of 2021. And real per-person spending on public services no longer grows over the next 5 years in our central forecast. The Chancellor's decision to spend all of the underlying fiscal improvements in our forecast on net tax cuts in this budget means that the overall path of borrowing as a share of GDP is largely unchanged relative to our November forecast. From a post-war high of 15% of GDP during the pandemic, borrowing falls to 4% of GDP this year, and then steadily to around 1% of GDP by 2028-29. Were this path to be delivered, it would mean borrowing falls to its lowest level as a share of GDP since the start of the century. The unchanged path for borrowing means the Chancellor remains on track to meet his fiscal target of getting debt to fall as a share of GDP in 5 years' time. Underlying debt rises from 89% of GDP this year to a peak of 93.2% in 2027-28, and then falls slightly to 92.9% in the target year of 2028-29. Headroom against his debt falling target is around £9 billion. This is £4 billion less than he had back in November, mostly due to the cost of the policies announced in the budget. £9 billion may sound like a lot of money, but as you can see from this chart, it's a third of the average margin of £26 billion set aside by all chancellors against their respective fiscal rules since 2010, and it's the second smallest margin after Jeremy Hunt's budget from this time last year. And it's useful to weigh the adequacy of that very modest amount of fiscal headroom against the array of potential risks to the fiscal outlook. Based on historic forecast errors, we estimate there's only a 54% chance that the main fiscal rule will be met, which means there's a 46% chance that it won't be. In the final year of our economy forecast, it would only take labour participation to be another 0.2 percentage points lower, interest rates on government debt to be 0.3 percentage points higher, or nominal GDP growth to be 0.3 percentage points lower to wipe out this headroom entirely. On the fiscal side, key risks come from stated government policies on both the tax and spending side, whose implementation is subject to question. The most doubtful of these is the government's stated intention of delivering an RPI plus 5p indexation of fuel duty next year and RPI indexation after that. Freezing fuel duty at its current rate instead as every government has done since 2011, would knock £4.5 billion off the Chancellor's headroom. Our fiscal forecast also assumes that all of the main personal tax allowances and thresholds are frozen for an unprecedented 6 years, with each year of the freeze delivering an additional £7 billion in revenue relative to indexation. Given higher inflation and net migration since they were first set out, the government-stated departmental spending plans now entail no real increase in per-person spending on public services over the next 5 years. But beyond March of next year, the government's not set out any detailed plans for how much spending restraint would be delivered, while also meeting its commitments to growing spending on several major services, including health, defence, and overseas aid, in line with or faster than GDP. In summary, while GDP growth has disappointed since our last forecast, we expect a steeper fall in inflation and in interest rates to support a stronger recovery in output this year and next. And while we now expect higher population growth over the medium term, we also expect a smaller proportion of people to be active in the labour force. The net result is an underlying economic and fiscal forecast, which looks very similar to the one we presented 3 months ago. And that forecast requires some difficult choices if you want to stop debt from rising as a share of national income, which the Chancellor says he does. In this budget, he's delivered a second 2p cut to the headline rate of national insurance. But he's also confirmed a wider set of decisions which keep the overall tax take rising to its highest level in over 70 years. And by leaving departmental expenditure plans largely unchanged in the face of higher inflation and population growth, he's also chosen no real growth in spending per person on public services over the next 5 years. These choices are just about enough to deliver the remaining 3% of GDP reduction in borrowing needed to get debt falling in a world of relatively slow growth and much higher interest rates. But the outlook remains uncertain, and the £9 billion of headroom that the Chancellor's left himself against his main fiscal target is a tiny fraction of the risks surrounding this or any other 5-year forecast. And with that, I'll hand it back to Steve to take your questions.
Good. Thanks, Richard. OK, we have plenty of time for questions, and I can see quite a few coming in via Slido, but we should reward the people who've come to the press conference first. So if you just put your hand up, and if you wait for the mic and introduce yourself, please start over here.
Jack Barnett from The Times. You've obviously outlined there's quite a big spending squeeze coming down the line still, about 8% lower compared to the October initial plans. You've obviously outlined some of the risks to the government not meeting what is pretty small fiscal headroom. I mean, would you say that the biggest risk to them not meeting that is that they're just going to raise public spending after the election, or whichever incoming government that is?
I think risks come from all sorts of different sources. There's £4.5 billion worth of risk on fuel duty from just doing what every government has done since 2011. Very small changes in the macroeconomic outlook also pose risks to the public finances. But there are also risks around the path of public spending, especially given how little detail there is about how the government plans to live within that very constrained envelope for public spending beyond the current spending review. Thanks.
Thank you. David Robinson, Market News. You point out that asset sales by the Bank of England will raise average maturity of debt from 1 year to 3 years and down on to 7 years by the end of your forecast. Same time, you have debt interest costs falling quite sharply. Is that a big success for quantitative tightening? Is that one thing that's actually worked well?
Do you want to have a go at that one, David?
Well, what's happened? The reason why things get a bit better on the cost of debt front is I don't think it's so much that the maturity of the effective maturity of the stock of debt is coming down. That's an almost inevitable byproduct, as you know, of the asset purchases by the bank slowly reversing and the stock running down. It's much more to do with the profile of likely interest rates. And we use, as we always do, the market expectation of where yields will go, which, having been pretty unfavourable for much of the last few years, has turned into a more favourable direction now. And if that plays out, that does make the debt costs look a bit better. But I don't really think it's an awful lot to do with the Bank of England running down its stock of asset purchases. I mean, even if the maturity stayed where it is, and there was a lot more very short-term debt out there, given that the market expectation is the bank rate will come down, you'd have still got the benefit that way as well, I think.
Maybe just to add a couple of things. So we do some sensitivity analysis in the report on the overall net cost of the asset purchase facility over its lifetime. And that has come down quite considerably since we did the estimate in November, primarily due to the fact that interest rates are lower. We also do some sensitivity analysis looking at if interest rates were 1% higher or lower, just to show the sort of scale of the sensitivity of that cost to interest rates, which is very substantial. We also do some analysis looking at the impact that the APF has had on the average maturity of our debt stock, and that has been an important factor in increasing the volatility or the sensitivity, rather, of the public finances to movements in interest rates. And it is the case, as you've seen, that the fact that the APF is unwinding over time does mean that maturity is now starting to lengthen, and so that sensitivity is reducing a bit over the forecast period.
Any more questions in the room at the moment? No. Okay. Let's switch to some online questions then. So I think this one's probably for you, Richard. It's from Phil Aldrich at Bloomberg. If you factor in the new market interest rate curve, the inevitable freeze in fuel duty, and the pledge to spend 2.5% of GDP on defence by 2030, what would the fiscal headroom be?
Some of those would be enough to wipe out headroom altogether. So trying to get defence spending from where it is now, which is around 2% of GDP, to 2.5% is 16 billion. So that's more than the Chancellor set aside in the budget against his fiscal rules at the moment. Freezing fuel duty rather than indexing it is about 4.5 billion, so that's about half the headroom that he has. The movements in interest rates we've seen since we closed our forecast is the smallest of those numbers. It's around £3 to £4 billion a year on interest costs. So the defence commitment would be enough to consume all the headroom. Fuel duty about half of that, and interest rate movements just in the last few weeks a bit less than that.
Okay, thank you. Question from Phil Edmond at The Guardian. Has extra borrowing played the largest role in funding tax cuts in 24-25? And then there are a couple of questions about the strength of our GDP forecast relative to the bank and NISA, why we are more optimistic than the bank. Richard, do you want to take the question on extra borrowing playing the largest role in funding tax cuts, and then maybe David come in on optimism?
So the extra tax cuts raised just north of sort of 10 to 12 billion pounds by the end of the forecast period. There are some significant tax increases as well in this spring budget, most prominently from the new non-dom regime, but also new taxes on vapes, as well as on carbon imports and some other anti-avoidance measures, which offset around half of the gross cost of the tax cuts. But in net terms, you're still adding around £4 billion by the end of the forecast period in order to fund what is a net tax cut in this budget of around that much.
Yes, we are a bit more optimistic on the central forecast. I mean, everything we're talking about so far has really been on the central forecast, around which there's a good deal of uncertainty. But that central forecast is a bit more optimistic from the OBR than the bank's one. I think there are at least three factors at play there. The first is that I think I'm right in saying that over their somewhat shorter horizon that the bank forecasts, they don't think an amount of slack in the economy, spare capacity, unused capacity, is used up. And we think that it does get used up over the course of the next few years. Of course, we had knowledge of what the tax announcements were going to be, the most significant of which in terms of the supply side and the productive capacity of the UK is the 2p cut in the NICS rate, which we think adds about 100,000 to the workforce, and that's a driver of GDP growth. And we're also a little bit more optimistic, and have been for a while, and have not always been right on this either, about productivity growth, which has been dismal by anybody's standards over, well, a long time now. I mean, certainly going back to the financial crisis. And who knows whether the next 5 years will be as bad as the last 15 years, or whether it'll return to a more normal rate of productivity growth for the UK over the last 50 years, which is probably more like 2% than the close to zero we've had. It's hard to know which of those is more likely. We take a kind of middle position that productivity growth will be about halfway between the dismal last 15 years and the much less dismal last 50 odd years. The bank is a bit nearer the dismal side of all that. So I think you add all that together, and there's a kind of meaningful difference then between at least the central forecast of the OBR on where GDP gets to a few years down the road and where the bank gets to.
Okay, thanks, David.
I hope we're right.
Let me take a couple more online questions, and then we'll come back and check if there are more questions in the room. This one's probably for Tom, and from someone who's been following the monthly public finance numbers closely.
Right.
So January saw a record surplus in tax receipts, which are up strongly. So why is your forecast down relative to November?
Thanks. So it is the case that there was a surplus in January. On the tax side, part of the reason for strength in January was that HMRC identified some PAYE receipts that were not previously registered on their system. And once they were identified, that increased their estimate of income tax and NICs this year. But that actually offset some shortfalls that we saw against our forecast in November in the other main receipt streams, which is why that overall our latest forecast of tax receipts this year is slightly lower than we were forecasting in November. The biggest reason why our overall borrowing forecast for this year is lower than we were forecasting in November is actually on the debt interest side, basically because RPI has come in lower than expected. That has reduced short-term debt interest costs.
Thank you, Tom. A question from Sue Chan, which I think maybe you want to take this first, Richard, and then others might want to come in. What would it take to get the tax burden falling? Also, where do you see economic inactivity heading by the end of the decade, and what is this driven by?
So the tax to GDP ratio has been rising since the pandemic. We think that between the end of the pandemic and the end of our forecast period, it will have gone up by around 4% of GDP. About 3% of that, percentage points of that has already happened. So 3/4 of the rise in the tax burden has already happened. There's about 1 percentage point left to go over our 5-year forecast period. So I guess the short answer to Sue's question is that it would take, at least on doing that further 1% rise in the tax take, and that's kind of broadly equivalent to the tax cuts that Jeremy Hunt has already announced in his recent fiscal events. If you combine the NICs cuts together with the corporation tax capital allowances measure, that gets you to around 0.9% of GDP. So it's sort of roughly the same again on what you've seen in recent Jeremy Hunt fiscal events.
David, do you want to add something on inactivity?
Yes. Inactivity had fallen back quite a lot a couple of years ago after COVID, but it now looks, unfortunately, from the latest year or so's data, that inactivity has gone back up again. So there hasn't been any recovery, really, from the big rise in inactivity in the UK that happened during COVID. And the single biggest factor there has been the number of people inactive who have health conditions which are preventing them from looking for work. And I think where that goes over the next few years is going to be one of the big drivers of where our inactivity might be by the end of the forecast horizon. And it's hard to know. The Chancellor announced earlier today some measures to improve public services, productivity in the public sector, and they're very largely directed at the health service. So there's a chance that more people will be helped back into the labour force and the number of people outside it due to health reasons will fall off. But I don't think anybody can be extremely confident about that. But it certainly has a big effect, most importantly, on the welfare of those unfortunate people. But it also has an aggregate effect on GDP and tax revenue coming into the government. So it has a fiscal effect as well.
Thanks, David. Question in the room.
It's just a bit of a follow-up to what you've just said, which is that given that we've got higher levels of immigration, you would think that that would be adding to the active population.
To the
active population.
To the active population.
Yeah, rather than, so why, I mean, what is going on there? Because these are big numbers we're talking about in terms of the migration figures.
Well, the participation rate of the migrants into the UK is relatively high, primarily because most of them are of working age. And so over the forecast horizon, that does add to the labour force in the UK. Of course, the labour force would be higher again if the inactivity rate amongst the resident population were to fall. The fiscal effects of migration over the forecast horizon are highly likely to be beneficial for two reasons. One of which because they boost the size of the labour force, pay taxes, taxes come in, and also because at least for several years it's highly likely that the migrants have they're net payers of taxes relative to users of public services, and on the whole are not eligible for welfare payments for some years. Of course, that turns around in the longer run, but in the short run, I mean, you do get a beneficial effect. But to come back to the main point and linking into inactivity, it's unambiguously better, I think, for many reasons, if the inactivity rates amongst the domestic population, particularly those that are driven by health, were to be lower, regardless of what happens on migration.
Thanks, David.
Very interesting. I was just looking at the costings of measures with high degrees of uncertainty. And actually, of the 8, 5 are very high and 3 are high. I just wondered if you'd like to expand a little bit on some of these measures and why you've got such high degrees of uncertainty. I mean, look, I know it's behavioural changes and so on, but it would be nice to hear a little bit more about those.
Tom, do you want to take that one?
Yeah, sure. So, well, yeah, you're right, as you say. Those costings which we feel are particularly uncertain tend to be those ones where we think there will be a large behavioural response, but the size of that behavioural response is always quite difficult to estimate. There are also a set of measures where the sort of data on the tax base is quite uncertain, and that it also adds to the uncertainty around costings. So just to take a couple of examples at this event, the reform to the non-dom regime that the Chancellor has announced is a costing which is particularly uncertain for both of those reasons. There is reasonably good information on the foreign income and gains of non-UK tax residents, but always going to be quite a bit of uncertainty around that. And then there's also uncertainty about the degree to which people who are not eligible for the new regime will respond, in the sense of some people may choose to leave the country because of the higher tax requirements on them. And there's also a likelihood that the people who stay will use tax planning to a certain degree to reduce their tax liabilities. So we have broadly made an assumption that around 40% of the sort of potential yield from that measure is lost as a combination of those two reasons. But there is a lot of uncertainty around that. We had a bit more evidence this time because this regime was reformed in 2017, and so we were able to look at what happened then and base some of our judgments on that. But I mean, this is a different reform, So that uncertainty remains.
More questions in the room? No. Okay, we'll take a couple more online then. This one is definitely for Richard. Should the OBR have a role in assessing the fiscal impact of the opposition's manifesto?
It's not a role given to us in the legislation that founded the OBR and enacted by Parliament, so it's not a role that we're given. It is a role fulfilled by fiscal councils in other countries, including in the Netherlands, but it's not one given to us, and so we look at government policy, but we don't look at opposition policies.
Okay. And then returning to some discussion we had on the impact of change to our population forecast, but this time looking at the fiscal side of things. Tom, a question from Henry Saker Clark. What additional revenues are expected from the increase to population forecasts?
So we've got some analysis of this in the report, and David's talked a bit about it. So we do some analysis essentially of the impact on both revenue and spending of higher population driven by higher net migration. There are two sources of revenue from higher migration. One is actually that migrants pay fees and charges to come to the UK. And then the other, and much more substantial, is the general tax revenue that they pay when in the UK. And we assume migrants tend to be concentrated in working age, and therefore that the revenue received from them is sort of close to the average of the UK population. We've got some estimates that combined is around 6.5 billion in the latest forecast. That's the additional revenue from the higher migration in the forecast. We also look at the spending side, where, as David said, in terms of welfare spending, actually most migrants are not eligible for welfare when they first arrive in the country until granted indefinite leave to remain. So there's no impact or very little impact on welfare spending. On public services more generally, obviously migrants will be using public services, but there's no automatic link between population and public spending allocations. And on the basis that the government's sort of public service plans through departmental expenditure are currently fixed and not adjusted, that means that additional population doesn't increase public spending, but it does increase the pressure on departmental spending within the envelopes they're given. We do also look at some sort of sensitivity analysis looking at the impact if departmental spending were to adjust to higher population, which obviously offsets some of the additional revenue. It probably doesn't offset it completely in the medium term, because migrants will, because they tend to be working age, will use public services less than an average UK person would do. Over the longer term, that of course might well change as migrants get older, have children, and become greater users of public services. So the sort of overall fiscal impact, I think, over the longer term is much more uncertain.
Thanks, Tom. A couple of questions about the economics underlying our forecast, David, so I'll direct these your way. The first of which is, are the Chancellor's tax cuts inflationary? And the second is, the Chancellor claims you are now adherents of the Laffer curve. Was this an accurate reflection of your thinking?
Well, the main tax cut, the most significant one in the budget, is the cut in the national insurance contribution rate. That does two things. It gives people a bit more money. And if nothing else changed and people are likely to spend most of that money, it has an upward impact on demand relative to the supply potential of the economy. But the other thing it does is it reduces the marginal rate of income tax of the overwhelming majority of the people who are in the workforce. So something like 29 million people will find their marginal tax rate is a bit lower. And even if you assume a relatively small positive effect on that on labour supply from the greater incentive to work, because it affects so many people, close to 30 million, there's a meaningful positive impact on the labour force in the UK. We think that's around about 100,000. There's 100,000 also from the 2p off NICs back in November. So there's a kind of meaningful positive effect on supply, which probably is about enough to offset any increase in demand. So you've got demand and supply rising side by side. And therefore, our view was that the inflationary impacts of the measures in the budget, of the tax cuts, were small and not even obvious that they were even positive on inflation pressures. On the Laffer curve thing, I heard what the Chancellor said, and I think what he's referring to was our assessment that the small cut in the rate of capital gains charged on residential property, which obviously is not something that's charged for owner-occupiers, so it's a smallish proportion of the housing stock in the UK would pay capital gains tax. And that small reduction, we thought, actually ended up generating a small increase in revenue from that tax, partly because people who've been sitting on accumulated capital gains, owning properties that they weren't living in, might take the opportunity with a lower capital gains tax to sell now. And so you get a bit of a boost to transactions, and that generates the tax revenue. I mean, it also generates capital gains as people crystallize the capital gain. So I don't think we were making a general point that every decrease in taxes will increase revenue. It was this specific tax seemed to generate slightly more revenue.
Thanks, David. There's a question in the room.
Thank you. Your former colleague, Andy King, said that the OBR should produce a neutral baseline forecast on departmental spending. Is he correct? And is that compatible with your statutory obligations? Can you do that?
I think the difficulty is in trying to define what a neutral baseline for public services spending is, in that we've had periods in the UK where it's been rising as a share of GDP, and that's been delivered. We've had periods in the UK where it's been falling as a share of GDP, and that has also been delivered. So I think it's not entirely clear, because it basically depends on a fundamental set of choices about where governments want to spend public money. I think it's not entirely clear what neutral is. When we do our long-term projections, we do make certain assumptions that things like spending on health are driven by demographics and a certain unit cost for healthcare. But over a 5-year period, you can weigh against demographics pretty effectively, and I think it's what we try and do as best we can in the absence of detailed departmental plans from the government, which we don't have, is look at what their existing commitments would imply for the rest of public services where they've effectively said nothing. So they say they want to meet the NHS workforce plan, they want to keep defence spending at 2% of GDP, they want to keep the overseas aid to GNI revenue at 0.5, and we can illustrate what that means for all other departments in Whitehall. What the government hasn't said is, here are the consequences for all other government departments in Whitehall, here's what it means for the justice system, the Home Office, everybody else. And so we have to, in effect, treat that as a lump of other spending and say, here's what it implies, but it's subject to the government setting out its own detailed plans.
Okay, we've covered a lot of ground, so I think I'll maybe just take one more question online and then draw things to a close. Richard, maybe for you, what do you make of the claim that the average personal tax burden will be lowest since 1975? Does that imply, given the rise of the overall tax burden, that certain groups of taxpayers, e.g. higher income brackets, are being punished more heavily?
So the total tax burden is on its way to a level that we haven't seen since the 1950s. So the overall tax burden is heading higher than where it was in the 1970s. I think the reason why you might see a lower personal tax burden on average compared to the 70s is probably two things. One is that over time you've seen more and more of the personal tax burden get concentrated amongst wealthier taxpayers as the personal allowances got up. And in particular, since 2010, it was raised significantly, so that took a lot of people out of the tax system and would have brought down the average and concentrated more of receipts at the top end. And that's also where you've seen quite a lot of the earnings growth in recent years. But secondly, over that same period, what you've seen is a tax system which is rebalanced, where it gets its revenue from personal taxation to indirect taxation. So in particular, the advent of value-added tax as a major source of government revenue has allowed the government to shift the tax burden away from taxing you on your income and on your earnings toward taxing you where you consume. And so that probably explains how you can have both a lower average personal tax burden but a higher overall tax burden at the same time.
Can I make a brief point, if I might? Can I make a brief point?
Yep, go on. Go ahead, David.
I just wanted to make a brief point about the strategy and what our forecast implies. And there's no way around it, really. The tax takeout of GDP on our central forecast is rising gently, but nonetheless rising to a level that's amongst the highest in the post-Second World War period. And government spending as a percentage of GDP is falling. And you can look at that and say, gosh, I wish that weren't true, but it is true. And it's almost inevitable that those things happen if, as the government wants, you are on a trajectory which stops the debt to GDP ratio simply rising and rising and rising. So one can look at those unpleasant facts and say, oh dear, can't they do something different? And the question, anybody who puts that question needs to then answer the following question, which is, if you're not going to do it this way, what are you going to do about trying to stop the debt-GDP ratio rising and rising and rising?
Great. Thanks, David. That seems like a good point to end. So let me draw things to a close there. Just to add, there's plenty more excellent analysis available in our EFO, and you will be richly rewarded by making your way through it over the coming days. It is also the product of many late nights from the hardworking members of OBR staff, so let me take the opportunity to thank them on behalf of the committee for all their work. And finally, thanks very much for coming along today, joining us both in the room and online. And we look forward to you joining us for our next forecast, whenever that may be. Thank you.